Chapter 1. The Retail Trap. The Misconception. Welcome to Episode 2. While the P&L statement tells us about a company's profitability for a single financial year, the balance sheet presents an entirely different dimension of financial information. The P&L answered, "What earnings did the business generate during the period?" The balance sheet answers a foundational question. What does the company own, and how was it financed? It contains cumulative financial data tracking the financial evolution of the firm since its very incorporation until a specific point in time. Many investors look at a balance sheet and treat it as a static, secondary compliance document. They glance at total assets, notice that the numbers balance perfectly, and assume everything is stable. This is the retail trap. Amateurs overlook the fact that the balance sheet reflects how the company has evolved financially over the years, making it one of the strongest indicators of a company's long-term financial fitness. If you do not know how to read the perimeter of what a firm owns versus what it owes, you are investing with absolute structural blindness. Chapter 2. The Institutional Mechanics. The Real Concept. To analyze a firm like an institution, you must understand the core balancing logic of the statement. The entire document is governed by the foundational balance sheet equation. Assets equal liabilities plus shareholders' equity. This means that everything a company owns must be financed either through internal owners' capital or external liabilities. Let us break down shareholders' equity, which represents the internal obligation of the company to its owners. Broadly speaking, shareholders' equity equals capital invested plus retained earnings. This is driven by an essential accounting principle. The finances of the owner are entirely separate from the finances of the company. Therefore, the capital put in by the owner to set up the business is viewed as an obligation to that owner by the business entity. Retained earnings, classified under reserves and surplus, hold the cumulative profits generated by the company over the years that have not been distributed as dividends. External liabilities are systematically divided into non-current and current obligations. Non-current liabilities represent long-term commitments that the company intends to pay off beyond 12 months from the balance sheet date. Current liabilities, conversely, are obligations expected to be settled within 365 days or less. On the asset side, the company records its resources controlled to create future cash inflows. These are split into long-lived fixed assets like land, buildings, plant, and machinery, and current assets. Current assets like inventories, cash balances, and receivables are expected to be converted into cash, collected, sold, or consumed within 365 days. Chapter 3. The Surgical Audit. How to read it. We will now execute a surgical audit using the actual financial tables of Amara Raja Batteries Limited, or ARBL, as of March 31st, 2014. Every single figure is denominated in rupee millions, which we will analyze directly to match the corporate ledger. Start on the equity and liabilities side. Under shareholders' funds, ARBL reports share capital of 170.81 million rupees. Share capital is the accounting value of shares issued, calculated using face value, not market price. Next, look at reserves and surplus, standing at a massive 13,456.20 million rupees, up from 10,427.33 million rupees the previous year. This brings total shareholders' funds to 13,627.01 million rupees. Notice something critical here. Almost all of ARBL's capital structure is funded through shareholder equity rather than debt. Move down to non-current liabilities. Long-term borrowings stand at 759.47 million rupees. Digging into Note 4, we perform a deep disclosure dive. This debt is actually an interest-free sales tax deferment incentive from the state government, which the company plans to settle over a 14-year period. We also see deferred tax liabilities of 301.33 million rupees and long-term provisions of 369.57 million rupees, bringing total non-current liabilities to 1,430.37 million rupees. Next are current liabilities. Short-term borrowings are 83.83 million rupees. Trade payables stand at 1,277.79 million rupees, representing credit extended by vendors, adding other current liabilities of 2,156.68 million rupees and short-term provisions of 2,818.73 million rupees brings total current liabilities to 6,337.03 million rupees. The aggregate sum of all liabilities and equity equals exactly 21,394.41 million rupees. Now shift to the asset side to verify how this capital was deployed. Under non-current assets, we find fixed assets. Tangible assets are reported at their net block value of 6,198.94 million rupees. Note 10 reveals this is the gross block of building, plant, and machinery minus accumulated depreciation. Crucially, look at capital work in progress, or CWIP, which sits at 1,443.60 million rupees. This is one of the first line items analysts check when evaluating future capacity expansion. It represents capital expenditure already incurred on incomplete factories or unassembled machinery. Adding intangible assets under development of 3.14 million rupees, non-current investments of 160.76 million rupees, long-term loans and advances of 567.69 million rupees, and other non-current assets of 1.22 million rupees brings our total non-current assets to 8,408.31 million rupees. Finally, audit the current assets. Inventories stand at 3,350.08 million rupees. Trade receivables stand at 4,527.89 million rupees, representing cash owed to the company by its distributors and customers. Cash and bank balances sit at 2,945.67 million rupees. Short-term loans and advances are 2,119.30 million rupees, and other current assets are 43.16 million rupees. Total current assets equal 12,986.10 million rupees. When we add our non-current and current assets, we arrive at exactly 21,394.41 million rupees. The balance sheet equation holds perfectly. Chapter 4. The Weaponised Application. Red flags and trade-offs. Now, let us apply this information to execute a deep financial verification of the capital structure. First, examine the debt profile. Many investors assume a complete absence of long-term borrowings is an absolute positive, but you must question the underlying cause. Is it because the business generates sufficient internal cash flows? Is it because management has chosen a conservative capital structure? Or are lenders unwilling to extend credit? Or is management not pursuing expansion opportunities? Second, cross-examine the CWIP line item. A large CWIP balance that remains stagnant for years deserves deep investigation. It can signal delayed construction projects, capital allocation problems, or vital production assets that are simply taking longer than expected to become operational and productive. Third, monitor the relationship between trade receivables and overall revenue growth. If trade receivables are spiking wildly out of proportion to top-line growth, it can signal aggressive credit terms extended to buyers or growing customer collection issues, which warrants further investigation. You must read the balance sheet as an integrated ledger of risk. Only by tracking the perimeter of capital structure can you evaluate the true financial trajectory of the enterprise.